How can an RIA firm thrive at the intersection of organic and inorganic growth?
Without organic growth, the mergers and acquisitions don't make sense. They just don't.
And what is the magnitude of opportunity that exists in the hybrid RIA channel?
I didn't want the broker-dealer assets to just be an afterthought.
On this episode of Growth Leaders of Wealth Management, I'm speaking with Kay Lynn Mayhue, president of Merit Financial Advisors, alongside two of Merit's regional directors and partners, Zach Mersberger and Tait. I also had the opportunity to speak with one of Merit's private equity investors, Rich Gill, founding partner of Wealth Partners Capital Group. From asking the hard questions.
If you're not consistently able as a wealth management firm to go out to the marketplace and successfully compete against your peers to bring in the next, individual client, are you a good firm?
To learning about mistakes.
You can hire yourself into unprofitability land really, really quickly if you don't figure out the art of leveraging other people's talents outside your organization.
Join me as we get to know Merit Financial Advisors, a company that emphasizes intentionality in both organic and inorganic growth. That's right now on the Growth Leaders of Wealth Management. Before she became president of Merit, Kay Lynn Mayhue spent many years as a financial advisor. It is a perspective she regularly draws on and considers an advantage to her leadership. When she joined Merit in 2017, the firm's assets stood at $2 billion. Today, they are over $11 billion plus retirement assets. And while Kay Lynn would love to say that much of that growth was organic, it wasn't. 90% was inorganic through mergers and acquisitions. Even so, Merit's business strategy is to have an equal 50-50 focus on and investment into both organic and inorganic growth. I asked Kay Lynn why this equal focus is so crucial to Merit's success.
The one thing that we have that is limited is time, and that's all of us, right? That's really what leadership is you're helping your team allocate their time and their resources, whether it be financial or time. And I think it's all intertwined when you look at it, because without organic growth, the mergers and acquisitions don't make sense. They just don't. They don't make financial sense. If you're not going to take a business and help it grow quicker than what it was doing before, then you've likely just made a really bad investment in that business, right? And because our business, unlike others out there, it's a depleting business. I call it the leaky bathtub. What do we do with our clients is we prepare them for retirement. And then once they get to retirement, they start taking distributions. And so you've got that like level water, and if you do nothing, that baseline is going to go down. And so you have to have organic growth just to stay at par. So it's really, really important from a firm standpoint to make sure that you've got your strategy in place to know, what is your distribution rates? What are your client attrition rates? If you've got an older client base, how successful are you in converting that relationship to that next gen as far as the beneficiary of your clients, as whether it be husband and wife pass away or an adult child comes in to help the surviving client and go through their navigation of the financials. And so I think it's so intertwined, because you can't have one without the other. You can't make investments in your business if you don't have organic growth. Even if you've got the greatest capital partner and greatest debt partners out there, eventually they're going to look at your model and say, wait a second, I don't care what you're doing on the mergers and acquisition side. If you're not helping those businesses grow from where they are, we haven't made a good calculated investment here. So it's so important.
Rich Gill is a founding partner of Wealth Partners Capital Group. His firm made a growth investment into Merit in 2021. Here is his take on Merit's equal focus on organic and inorganic growth, even though the actual growth at the firm has been 90% M&A driven.
The way to sustainably grow that we've seen is, one, be a little bit more price disciplined in the firms you're acquiring. One way to do that is buy talent that grows scale with you rather than buying big bites of scale that are very expensive. And two, make sure that you're always building out your organic growth channels with the same level of rigor you bring to your acquisition. And we're always looking for new channels. Merit historically has been very good breaking into some of these companies and offering solutions to their retirees. But in the last year, Merit's added a dozen new organic growth channels, and we're starting to see some of those pay off. If you're not consistently able as a wealth management firm to go out to the marketplace and successfully compete against your peers to bring in the next, individual client, are you a good firm?
This equal focus on both organic and inorganic growth has been vital to Merit's success. Before we dig into what is working for Merit on the organic side, let's learn about Merit's inorganic strategy. From my perspective, Merit has dominated their M&A strategy by focusing on the overlooked and somewhat opaque market of BD advisors. And they have built multiple affiliation models to meet these advisors where they are at. Merit built a multi-million-dollar tech platform which allows businesses and advisors to partner with them for different reasons. They can plug into the firm's growth machine and hopefully accomplish their goals quicker. Or if an advisor is looking to do less of what they're doing now, Merit also has a model that can act as more of a succession strategy. Regional Director and Partner Tait Lane explained these models in more detail.
We have a couple different entry points, and I think it's vital. It's why we have them, because when we begin to have conversations with sellers or potential partners, they're all at different facets. They all have different pain points, and that's really what our job is to do, is figure out, hey, what's the pain point? If there's not a benefit that's greater to move, they're never going to move. And so we have what's called Merit Amplify, which is a 1099 affiliation channel, which allows somebody to remain fully independent. They can fly their own flag, use their own DBA. They got all the managerial and leadership controls that they would, but they can utilize our tech stack. They can lean into some of our enterprise pricing with like human resources and compliance. The payouts are great. We can generally offer some competitive transition assistance. And so if somebody comes to us and says, hey, I'm not quite ready to go through a full partnership, a full sale, and this is what we call kind of engaged but not married. And it's a great place. We've got a number of teams that are on that platform, and there's really no pushing of the Merit name in their firm unless they want to. Then we're able to meet advisors that are truly succeeding out. So if they come to us and say, hey, I'm under a year and wanting to exit out, we've got certain regions, not across the country yet, but we have certain regions like mine that have capacity to meet those needs. So if somebody comes in and says, hey, you guys are great, but I'm just really worried about valuation and making sure my clients have a good home or whatever it is they're trying to solve, we can meet them. And then the third, and really what we're hyper focused on as a firm that's approaching 12 billion roughly, depending on the market, is what we call talent partnerships. And that's where, again, kind of like our firm, they've got strong team members and processes where they want to come on and help us grow, get in the boat and row in the same direction. And from Merit's perspective, one of the things that, again, separates us from a lot of our bigger competitors out there, we have one share class on our equity, and so we all win.
All of these affiliation pathways have enabled Merit to get to scale. But to attract the diversity of leaders and partners they wanted, they had to pair their inorganic strategy with an intentional focus on inorganic growth. Here's Merit President Kay Lynn again to dive into their thoughtful and intentional approach to organic growth.
So we've got these organic growth tracks that our advisors are able to plug into. And we call them a track for a reason. If you can imagine like a high school track where the football field's in the middle. So that track has been built and it's there, right? But you're not actually going to get any exercise by sitting there looking at it, right? right? So our advisors, they have their part in this, and then we've got our part too, to where the company does believe it's the lion's share of the company's responsibility to be able to put that appointment on the advisor's calendar and give them the opportunity to meet with those prospective clients. So we've got things like our CPA Connect program, which is where we partner with CPAs in a revenue share arrangement. That's been a great success in helping a couple of our advisors, actually more than a couple of the advisors now, really grow their client bases and build the influence and impact that they're able to have. We've got other niche markets where we've got several of our advisors that like to focus on working with women that are going through divorces or widowhood. We've got others that are focused on certain Fortune 500 companies where we're a fringe benefit. Our financial planning and investment services are a fringe benefit that are offered to those executives. So we've got those organic growth tracks, because I don't think you attract on the mergers and acquisitions the right kind of people and businesses unless you have that organic growth story that you can help them grow on the other side of the transaction.
My perspective differs from Kay Lynn's a bit here. I believe that advisors have a huge ability to accelerate growth for their firm. I don't agree that a corporate entity should maintain the lion's share of the responsibility for driving leads. I think advisors have tremendous power to be individual growth channels that can greatly accelerate an RIA's growth. I love digging into different perspectives because I believe this is where we can truly learn. So I shared my perspective with Kay Lynn and was curious to hear her thoughts.
There are those advisors that do have those unique opportunities, and they've got a great network. They're going to continue doing what they've been doing, and we're going to support them in really unique ways. We've got client development managers that are basically boots on the ground, salespeople. They're not licensed. They don't compete with the advisors because they're not advisors, but they go out there and help those advisors in those communities that they're already in with event marketing, love affair marketing, sponsorships, things along those lines. They're just a great asset. So the advisors that want to continue doing that themselves and just want the corporate lead gen to be an enhancement to that, great. We want to support them and we want them to be wildly successful. I would also say, and when you've got those, let's call them the unicorns that are leaving, those founders that were out there knocking on the doors, you've got those advisors that, in order to keep that level set with those distributions and the client just natural attrition, which ours is super small, but it's still there. They've got to have some momentum to plug into. And so that's where the company comes in and fills that void completely. And let's face it, I mean, from an advisor standpoint, our clients want to know that their advisors are doing what they want them to, which is advise them and watch their investments and look at their financial plans and make sure that they're doing what they want. Our clients don't want to think that the advisors are having to spend 50, 60, 70% of their time out there on new business development. So the more that we can do from a centralization standpoint or an institutionalization of the marketing, that benefits our clients. And that's a great thing for our advisors. That's a great thing for our clients. And that's a great thing for the communities that we're in.
Interesting perspective, right? I maintain my belief that advisors are often untapped individual growth channels and that RIAs can find a lot of scale here, but I completely understand Kay Lynn's approach. Across the industry, there are many firms that say they can help their advisors grow faster. Merit aims to be better equipped by intentionally creating a variety of organic growth tracks. I asked Kay Lynn to explain how the tracks are developed and implemented across the company.
They have been through partnerships. meaning we have partnered, we've done a transaction with someone that was wildly successful doing something within that vein. And what we do is we ask them to come in and help us leverage that across the company. And we provide them a ton of resources and a ton of upside to do so. And I think that that's why it's really taken off to where you don't just it's not just slinging a bunch of mud, right? Like, oh, let's try this or let's try that. It's like, okay, so here's someone that has dominated a market, whether that be regionally. I'll take our Connecticut office as an example. They have just an amazing community and a network that they've worked out there local with women that are going through divorces. And so we have taken that, and there have been other advisors throughout the country and within the Merit ecosystem that have learned from that and adopted that same process. So it's same thing with CPA Connect. We had one of our offices that had built their entire business off of partnering with a CPA firm, and it was wildly successful. And so why would we reinvent the wheel? Why not figure out what worked for them and then take that and duplicate it? And so that's exactly what we've done with the majority of these organic growth tracks is taken someone's idea that became a success, brought that in and put a bunch of resources around it to make sure that we could scale that and really take advantage of it across the Merit universe.
And then is the upside that you're referencing that everyone owns, owns an equity stake in Merit. So the faster and bigger that the organization can grow through some of these growth tracks, therefore their equity is growing, or is there a different upside? So, if, for example, the people in Connecticut that have defined this process for working with women in transition, do they do joint work? And there's also that upside?
Absolutely. So it's really threefold. Our equity is our most precious commodity, and we try to reserve it for the transactions where we really feel like someone's going to help us grow, either regionally or that they're going to help us grow nationally, which is really exciting. So there's also the upside as far as joint work, for sure. We've definitely seen that cross-pollinate across the offices. And then the third thing is just in compensation, to where we design compensation plans around incentivizing those. We have an LTIP program, which is our long-term incentive plan, which is basically additional partnership units in a profit sharing component. And we want to make sure we've got a grant that we do every year, and anybody that's leaning across and doing things that are outside of the realm of what you would look at for their job description and helping us lead and grow, we want to make sure that they are participating in the wild growth from an equity standpoint and an enterprise value standpoint that we have. So we use that LTIP program for those as well. And then there's cash compensation that comes into play also.
Merit partner Zachary Mersberger is a great example of this kind of partnership. His parents started Mersberger Financial Group back in 1994. Not only is Zach a great example of how Merit's approach to partnership and organic growth really shines, but it's also an incredible organic growth and family succession story in its own right. Let's meet Zach.
My brother Josh and I grew up in the business. I was 5, he was 7 when my parents opened the business. And I can remember they bought an old historic building, they renovated it. And Josh and I would, we would actually be in our sleeping bags in the old building watching movies while my parents were remodeling it because they couldn't afford to bring in contractors. So they did a lot of it themselves.
Zach's parents didn't have a single client when they started out. To stay in business, they worked hard while always keeping an eye towards what was best for their clients.
That's something our dad always said, if you just take care of the clients, no matter what, everything else will find a way of taking care of itself. So I think that gave us a unique perspective on, coming into the family business the right way and not having it be about ego and really having it be about, let's see if we can build something special.
Zach was always best friends with his brother Josh. Once they were older, they started working alongside their parents and eventually took over the business in 2015. During their tenure, the firm's assets grew from about $75 million to $1.3 billion, mainly through referral-driven organic growth.
We made a pretty conscious decision to really focus our marketing around brand recognition within, the local and regional community. And so, versus targeting like a specific client niche or something, and all of our marketing being targeted towards those people, we just had a very broad-based brand recognition type of marketing campaign or platform that was really focused on just making sure that the regional community knew who we were, knew what we were building. And so all of our advertising focused around, we're fee-based fiduciaries in the, Eastern Wisconsin area where we are. There was not another firm that had more CFAs and CFPs on staff in-house. And so we, hammered on that a lot. So fiduciary, the amount of expertise in-house, that extremely comprehensive focus. A lot of our advertising was really just geared around helping the community understand how we were different, what differentiated us. I think that's why for a number of years, we had an organic growth rate that was, north of 30% on an annual basis, which is, pretty hard to find. There's not many firms that do that. And I think we had a 6 or a 7 year stretch where our organic growth rate surpassed that. And a lot of that was from, referrals from existing clients, but then just creating that brand recognition to the point, that in the local area where we are, like I would say everyone almost knew who we were. And because we were so consistent with our advertising and branding, everything revolved around, kind of the same tag words of financial planning, comprehensive, CFPs, CFAs, fiduciary. And so people just started to associate us with, those terms.
Mersberger Financial Group, with their remarkable organic growth rates, merged with Merit just 2 years ago in 2022. What did that mean for all the work they had put into local brand awareness? Was it carried over? And how did the Mersberger team integrate their organic growth success into the broader Merit ecosystem?
Yeah, so I do think our focus on brand recognition has definitely crossed over into the broader Merit ecosystem. I think there were a lot of other regions that were more focused on marketing to a specific client niche. And that's where all their marketing was dedicated, and have now, started to incorporate more of just that general broad brand recognition. We do a great job of that at the corporate national level, but, we're now seeing advisors or local regional offices try to create that same, local brand recognition of who is Merit in the local community. And then the probably other growth tracks that I would mention that we had a focus on that have come over and kind of cross-pollinated into Merit, I would probably list 3 of them. So the retirement plan space, primarily employer 401k plans. We had one of our partners in Mersberger, his name is Don, actually leads that division for Merit on a nationwide basis now. And so, that's setting up and managing retirement plans, employer retirement plans, predominantly 401ks for employers really of any size, from your startup plan all the way to, I think our largest plan is a company with a couple thousand employees. So that was new to Merit at the time that we came in. And so, Don has kind of built that platform out company wide. And it's something now that all of our advisors can tap into. Second one is what we now call our Professional Partner Alliance. And so that is, partnering with other professionals to really generate referrals both ways. So a good example of that would be like within the property and casualty industry, partnering with really good independent P&C agents where, we use them for clients that have the P&C insurance needs. And then if they encounter their clients who have financial planning needs, they, would refer them to us. And so we had started that with a P&C agent with a lot of success, but we've actually now, transitioned that at Merit into a number of other areas where we're partnering with CPAs in the same manner, and then also partnering with banks, regional banks in the same manner, primarily, banks that do not have wealth management divisions in-house, but are looking to offer that to their clients. They will partner with Merit, and then, we've got a good partner for clients that have banking needs that we can't provide. So that'd be the second one, what we now call Professional Partner Alliance. And then the third one was Small Business Owner Services, specifically business valuations. And so we had a lot of success with helping our small business owner clients understand the value of their business. If they were starting to look at succession or selling the business, steps to take to maximize the value of that business, and then all the way through, if they're ready to sell, helping them figure out the type of transaction, the structure of that transaction that would make the most sense, and allow them to achieve what their personal financial goals were. So we had already built that out. Again, with getting access to a lot of Merit's resources, we were able to expand and improve what we were doing. And then that is now, again, something that's kind of gone company-wide, where all of our advisors at Merit have the ability to offer those services. We spent some time really going through the exercise of, okay, if this is going to go from a one office offering to a national offering, and a $10+ billion RIA with 80+ advisors, what does that look like? What do we need to change? Do we need to bring in some additional people to help, manage that? So kind of going through some strategic planning, but yeah, at this point, those have all been stood up at the national level. Training and education with our advisors, so they understand, what is this? What is the benefit to clients? What type of client is it targeted towards? And then, if an advisor thinks they have a client base that this would resonate with, helping them understand how to actually leverage that in their day-to-day planning work with clients. And then a lot of work, Merit has such a big focus on technology, and, part of our mission statement is that we're building the RIA of the future. So obviously the tech stack plays a huge role in that. So, when we look at things like our CRM, which is a heavily customized version of Salesforce, making sure we've got proper workflows and other processes built into the tech stack to support the scale you need to run something on a national level versus on a one office level. So a lot of work went into, working with the tech team of, okay, if we're going to design a workflow for like onboarding a new 401k plan as an example, what does that look like? And how can we turn that into an easily repeatable and scalable workflow that could be deployed to the entire field. One area we've been having a lot of success with on the organic growth side is another organic growth track, but this one kind of was brought in by Merit, and we've really been able to leverage it. And that is managing 401ks for our clients that are still employed. So, and these would be clients where we're not managing the 401k plan itself, but we're actually able, we have a software program that allows us to get a direct data feed into the 401k. We can see all the investment options the client has, and then we can, basically manage and rebalance and reallocate their investment allocation within their 401k on a discretionary basis, and then, bill for that advice. So for most of our clients, they are with us because they want us to holistically manage their entire financial picture, but we never had a way to manage their 401k, right? So it's always this account that was just kind of out there on its own. And when we ask most of our clients, how much do you watch your 401k? Many of them say, I haven't looked at it in a couple of years, and I don't really understand what's going on, in the market. So there is a big need for it. So that's been, an incredible benefit to our clients and to our advisors being able to offer that.
Most firms that you find on the Barron's top RIA ranking tout their fiduciary fee-only model. These firms either don't care to service commissionable business because it isn't aligned with their vision, or they just haven't figured out how to navigate it. Merit stands apart in that they have intentionally built their business as a hybrid RIA firm. That means they have a broker-dealer affiliation, which allows them to recruit seamlessly from the broker-dealer world. Merit leans into this as a big competitive advantage. Here's Kay Lynn to explain.
So it's probably about 60% of our advisors are hybrid advisors, meaning they have a broker-dealer affiliation. And I think that is somewhat unique in the marketplace because there's a lot of the larger RIAs that have not figured out how to navigate that system. And they basically are told when they knock on the door to get more information, or they get an outbound call, well, we've got to figure out a way for you to get rid of your broker-dealer in your commissionable business. And the hard thing is, I don't know if everybody realizes this. I know those that are in the hybrid world would know this. Most of the time, those clients that you're serving, they might be 90, 95, 99% advisory, but they have that 529 plan, or they've got that annuity that they had from another broker or advisor that they were working with years ago that now you're overseeing, or it was an old variable annuity that has some really, really great living benefits and death benefits that these aren't even around anymore. So of course the client should keep it. And so I think that that's been a really great thing for us to have that offering, and not only to have the offering, but to understand it. This is not just a small part of our business. So we're not accommodating it. We've built an entire process and a system around that.
Wealth Partners Capital Group was attracted to Merit specifically because of their hybrid approach. Rich Gill is a founding partner. Here he talks about both the opportunities and challenges that exist in the hybrid RIA world.
The things that drew us to Merit, we've been interested for a long time in the hybrid space, which I think has a number of sort of underappreciated differences with the fee-only RIA world. The fee-only RIA world is cleaner and easier to understand, and there's better information, right? If you're an RIA and you're over $100 million, you're filing an ADV with the SEC, and the things in it need to be true. And so mostly when we talk about wealth management and look at the firms, there's some service that scrapes all the data out of a big database that pulls off all these ADVs and says, this is the world. But that's not the world. It's a large part of the world by assets, but not by unit volume. There's a much larger universe of registered reps and teams of registered reps. And if, for example, some of those registered reps are part of a corporate RIA within a big IBD, do you know where we find that data on them? Nowhere. They're essentially invisible because they look like they're part of LPL or Commonwealth or whoever it is. So the space is large, more fragmented than the RIA space. It has a larger acquisition universe, and it's data poor. It's information inefficient. And that's very interesting to us because we help turn firms into serial acquirers. And here we were without a partner who could acquire in the hybrid space. And those are sort of the industry trends that were drawing us towards hybrid. We had been looking for a while. And because of some of the reasons we were just going through, not many firms in the hybrid space actually built up into a business because of the OSJs and the way these things work. It's much more fragmented and individual than the RIA space. I sometimes wonder, technically, commission payments go to the individual, not to an entity, not to your firm. And I sometimes wonder if that's led the commissionable world to be even more individual than the RIA world, which is more team-oriented, right? So they're almost set up more like insurance brokers than wealth management firms, even though there are some sizable groups doing, planning and other wealth management services. Merit, very unusually in that space, had a team, a management team, a department structure. They had, groups that they had centralized services. They had started the sort of work we would see in an equivalent sized RIA. And that's incredibly rare. So that was very attractive to us. And then even more unusually in the hybrid space, they cared a lot about culture. It was the deepest management team in the hybrid space we had encountered. And so since my firm, WPCG's, business thesis is, if we have the right firm, we think we can turn them into a very successful serial acquirer. But that only works if our partner has a foundation and a management team capable of integrating the stuff that we're bringing them and making it really work.
We've seen what some firms have done to try to accommodate reg rep business, or, trying to think through how do you acquire advisors who have been part of a corporate RIA. And so what I've observed and what I'd love to sort of get your perspective on is, they try to bolt onto an RIA friendly broker dealer so that they can maintain the commissionable business. But it seems clunky. It seems perhaps not it's like a off the side of the desk versus part of the actual platform business. And so it feels to me like it's probably been difficult for those firms to play in the IBD space because of all of these challenges and difficulties.
That continues to be our view. And look, the IBD space is not without its challenges, but what you're describing, I think, is right. There are fee-based firms who enter into a relationship with one of these small sort of accommodation broker dealers to handle like 1% of their assets. And that's going to work as well as any exception-based process ever does, which is not that well. And if you have 40% of your business is in commissionable products, for good reasons or bad, it might be legacy or it might be a point of view you have on the best way to serve clients, whatever it is, transitioning to a firm like that is going to be really, really hard.
Tough.
It's just all the operations are going to be exception based, and this won't work and that won't work, and who do you call, and they don't have staffing for it. They're just not built that way. And so if you're going to be an acquirer in the hybrid space, then you really have to have some sort of native presence in the world. You have to have a meaningful custodial relationship with a significant broker dealer that lets you operate in this way. And we're just not believers that you can do this on the side.
Merit operates with a hybrid RIA model with a focus on continuous improvement and strategic acquisition. Expanding their bench of talent through acquisition is a core part of the business. So how do firms like Merit discover firms like Mersberger in the broker-dealer world? How do they identify businesses that already have amazing organic or inorganic growth?
At some level, you have to go out and find them. Sometimes you run into them at a conference, but even that's not enough. You have to go meet them. You have to make it a major priority. That group over there, they are excellent, and they would make us better. We need to go get them. And so what I think we did is bring in enough manpower and resources for Merit to be able to go out and really identify the best talent in the hybrid space and bring it to tell the story of why they have a great firm, but they could actually do more under the umbrella of Merit that they could do on their own. These folks have this perfect entrepreneur's dilemma. They have a great business. They could keep running it, but once they get above certain inflection points, we usually talk about inflection points of scale at 300 million and $1 billion. Under 300 million, you can do whatever you want. Like you can run it out of your mom's basement. You can have no employees. It's fine. But once you get over that, you actually have to start to operate like a business. And by the time you get over $1 billion, if you want to keep growing, you have to run it like a real business. You have to departmentalize. You have to invest in a bunch of recurring overhead, compliance officer, chief operating officer. You have to get more sophisticated in the way you put together your technology stack. There are just a bunch of things you have to do. And so when we find one of these exceptionally talented teams in that, $1 billion range, the conversation is, look, your business is going to change. You can do it on your own, and you can make all these investments, and you can spend all your time doing administrative work. But just so we're clear, you're not an advisor anymore. You're a manager now. You operate a business. Or you could do it with us. We've already made those investments. And we just want you to do the things that you actually like doing, which are interacting with clients, finding more clients, and helping us acquire more firms in your region. We think you'll spend more time on the fun stuff with us. But to be clear, you could do this yourself. And so that's the sort of entrepreneur's dilemma that we find with these folks. And we feel like we can put together a pretty good value proposition, which is outsource the things you don't like doing to Merit. We think we're able to make a compelling pitch to folks like that.
As we've heard, Merit has a proven ability to acquire firms that are growing rapidly on their own. Mersberger is an example of an acquired firm that was experiencing rapid 100% organic growth. Before joining Merit, Tait Lane ran the firm Triad Financial Strategies. Their growth mainly stemmed from an inorganic approach, with a total of 15 acquisitions over 13 years. Here's Tait to explain why he decided to partner with Merit and how Merit's proactive, show-up-in-front-of-you approach to M&A worked.
I went out on a journey and basically talked to 13 different potential partners, most of them very well-known household names in the industry, and almost all of them, 11 of the 13, were first dates and done. They wanted to just focus on my bottom line. They wanted to cut my staff, centralize process, increase profitability, raise fees, change process. Like, wait a minute, why would you acquire me only to change what's working for me? By the grace of God, Merit actually cold prospected me, and why I decided to answer, I have no idea, because we get like 3 emails a day, but I did and entered into it. And when I first met Rick, who's our CEO, he asked me, what are you looking for? And I said, well, Rick, I said, to be honest with you, I don't think it's out there. At that time, I probably talked to 8 or 9 of the 13 firms. And I said, I want a firm that basically helps lift off of my shoulders a lot of the business functionality, the things that were created through success, like compliance, technology, human resources. I had gotten a bid for in excess of $1 million to build out our tech stack. And so I knew that I was at that precipice as a firm that I needed to invest to get us to that next level. And come to find out that what Merit really is designed around is taking that business operational stuff off of the founders, but leaving us alone to allow the culture and what made us successful remain. The role that I came on and Merit's focus of growth as an organization is to have what they call a hub and spoke strategy, which I don't know if it's unique in the industry or not, but when they move into a geographic area like they did in Seattle, they had no exposure here. They're looking for a firm like ours that had processes, had leadership that could come in, and then they can build around. And so they were a lot more comfortable with me probably early on in the process when they learned that was something we had done. And since then, since about 18 months, we've now done 7 acquisitions or partnerships since coming on board. And so they were able to lean right into us, which is great.
Tait was also attracted to Merit's hybrid RIA model.
Yeah, and that was you asked me about the repapering process. The one thing that was important for me, which may be different for other firms, is that I didn't want the broker-dealer assets to just be an afterthought. And in a lot of my conversations, they were. The acquiring firm says, well, we'll take them on, but we're going to stick them over in this closet, and you're never going to deal with them again. And there are situations where, again, even as a fiduciary-based advisor, there's sometimes situations where we don't want to put it into an advisory account. We work with a lot of executives in the technology space up here. And so one of my largest clients, we have 50 million in Microsoft stock. Well, that's just sitting in a brokerage account. We're not charging a fee on it, but to consolidate assets and have some tax harvesting strategy, we take that on. So I liked the fact, and we were having a lot of success as a firm, being able to meet advisors that have pure RIAs as well as that hybrid structure in their business.
As a final exploration, I want to take a look at not only what Merit has gotten right throughout their business journey, but also what they've gotten wrong. What mistakes were made along the way, and what did they learn from these mistakes? Here's Kay Lynn to explain how a couple of transactions early in her tenure with great industry friends actually went wrong.
These were some great friends in the industry that I had known for years, and a couple of other leaders had known for years. And what we were trying to do is we were trying to lead those offices centrally. And it became really clear, especially because these were spread out throughout the country. Anybody that is considering doing a merger or an acquisition with an office that is not in your geography, I would say stop and imagine life as far as with that office being standalone, and see if you have that leadership. Because what we did is we shifted our strategy to make sure that we weren't, when I said we've got those succession opportunities, Meg, we're only going to do those succession opportunities where we already have a leader and boots on the ground, because we have figured out it does not work to lead from a distance. I know in this virtual world, and we've got everybody that's working from home in certain offices or certain areas of the business or businesses just out there in the world. It does not work in our business, in a client facing advisor development, people development business, to have offices that don't have leadership. It just doesn't work. So I would say that's the very first thing that, and a lot of people will come to me like, hey, I'm in Houston and I've got this opportunity to buy a business in Michigan. What do you think? And my first question is, well, tell me about the Michigan team. What are you inheriting there? Do you have a strong leader? What have they proven themselves in the past? What kind of business is it? Because it's just too hard. You will drive yourself to an early grave, which we were well on our way to before we had the change of strategy. If you don't have, it's all about who you're partnering with and that leadership if you're not going to be geographically in the same area. One other thing, Meg, that I think would be important. So as you grow, I think people will get confused around pride of authorship. And that is what you have to do in-house. And I think it's so important as the businesses grow that you're constantly asking yourself, what should I do? And what should I partner with? Things like marketing, PR, technology, coaching, all of these things, we've got partnerships that we form with other companies and other people that are experts in their area. So figure out what you want to own and what you want to build, and then figure out the different things that you want to partner with others on, because that partnership means much more than just someone that's coming in through a transaction. It's also the relationships and the expertise that you can leverage in our industry.
Of course, I had to proudly pop in here to agree with Kay Lynn.
I knew you would.
Thank you.
But that's one thing that we made the mistake on. You're asking about mistakes. We thought at first we just had to hire it, and you can hire yourself into unprofitability land really, really quickly if you don't figure out the art of leveraging other people's talents outside your organization.
I so appreciate Kay Lynn being transparent with what hasn't worked, because the truth is you don't achieve the kind of growth Merit is achieving without making mistakes and having the capacity to learn from them. So looking ahead, what does the next 5 years look like for Merit?
We're not building like some companies out there to sell. We're building to transform. And so when you look at it through that lens, what does that look like? Well, we might have 20 organic growth tracks. I don't see having 200, but we might be doubling our paths that our advisors can plug into. We might have offices spread out throughout the U.S. even more so than we have right now. Could that be 1,000 advisors instead of 100 advisors? Well, it sure could. It absolutely could. And so I think the decisions that we're making today are based upon the business that is 5 years from now. So we're looking through things. How is the client best going to be served? How is the advisor best going to be served? How is the team best going to be served? And how can we build a company that maximizes personal development, that enables the advisors and our leaders to grow and reach heights that they couldn't do on their own.
Here's private equity investor Rich Gill with a final thought.
I would say if you're sitting around saying, aren't we at the top of our game? There's something wrong. Because you should never be saying that. Like, all of these number targets that we set are kind of fictional. 10 billion, 25 billion, 50 billion. I mean, they're just big round numbers. Like, what does that mean? Like, is it special because it's base 10? Who cares? Right? Instead, it's what are we doing better than other firms in the industry? What are other firms doing better than us? Why are they better than us? And why can't we build something that's better than that. So if we have the best planning offer in the industry, great. Do we have the best investment package? Do we have the best tax offering? Do we have the best insurance offering? Are we the best at marketing? I mean, it's unlikely, I think, that at any given time you're going to say we are the best at all of those things. So great. It's very competitive. I like that. Competition's fun. So if there's someone who's doing something better than we're doing it, let's go fix that. And let's go through it one at a time. And by the time you get to the last one, you back to the first one and someone else did something really cool and you need to improve. So I think it's a continuous improvement process. I don't think there is any end.
When it comes to Merit Financial Advisors, two things struck me as a really unique approach to building a leading RIA firm. First, operating as a hybrid RIA. And secondly, the intentional intersectionality of organic and inorganic growth. After speaking with the president of Merit and their partners, here are my 5 top takeaways. 1, organic growth and inorganic growth are totally intertwined. If you don't have an eye toward organic growth, mergers and acquisitions just don't make sense. 2, it's rare to operate as a hybrid RIA firm. Oftentimes, the fee-only RIA world, it's easier to understand. But for Merit, this structure has offered incredible advantages, including attracting high-quality, like-minded partners. 3, when looking to acquire a business that already has amazing organic or inorganic growth, it's not enough just to run into these people at a conference. You have to make the search a priority. Discovering top talent means going out and intentionally finding it. 4, creating and implementing a variety of growth tracks allows businesses and advisors to collaborate for different reasons, from a succession situation to tapping into a firm's growth machine. 5, when acquiring a business in a different location than yours, having boots on the ground is imperative. Trying to manage far-flung offices from a central location just doesn't work. I'd love to hear your takeaways from today's episode. Find me on LinkedIn and send me a message. You'll find a link to my LinkedIn profile here in the show notes. For more growth resources for your RIA, we have a ton of content that you can easily access at ficompartners.com/insights. Join us for the next episode when we'll be speaking with a unicorn fintech business, Vestwell. Until next time, this is Meg Carpenter, CEO and co-founder at FICOM and your host of Growth Leaders of Wealth Management.